My strategy was more so trying to preserve as much buying power as possible. So, meaning if I could make a 50% return on a single trade, I don't necessarily care that that's on the entire 1,000. What's up, guys? Welcome back to another episode of How Not to Lose $1,000, or whatever we were calling it. Or I guess how to lose $1,000 in 30 days. It's like that Sandra Bullock movie, something like that, right?
How to lose 1,000 in 30 days?
Yeah. This is officially the first episode where we're going to be talking about our specific options trading strategies and how we've done. Maddox, welcome back to the show. I don't know why I'm saying it as if you're not the only one on the show.
Thanks for having me back. I guess as long as we keep coming back, as long as we haven't lost our $1,000 yet. So
Yeah, exactly. Well, maybe should we dive in just talking about like our overall strategies and what we think, or maybe even before that, for the people that are new to the channel or new to this series. What Maddox and I are trying to do is we're trying to take our $1,000 options trading portfolio and turn that into whatever we can. We set $1 million. Realistically, we're just trying to see how long we can last without running out of money. And I presume we have wildly different strategies going into this. So maybe we can talk about kind of our overall strategy here. Do you want to go first? You want me to go first?
you can go first.
Okay. So my strategy was more so trying to preserve as much buying power as possible. So meaning if I could make a 50% return on a single trade, I don't necessarily care that that's on the entire 1,000. I wanted to make sure that I was making trades where at no point in time was I willing to give up more than like, say, 20% of my entire portfolio value. So I had an arbitrary number in my mind that I came up with before I started. I said $200 and I was like, okay, $200 is my play money. Let me see if I can make like a 50% return on that across multiple amounts of different trades and see what I can do for this first episode. Very quickly, the problem with that just becomes that like it's not a lot of capital to play with. I'm sure this is like some things that you like also like ran into.
Yeah, for sure. Yeah, like, and that's something I know we'll talk about our kind of lessons, but yeah, it's like you just you kind of need to like have a lot of capital to like open a options position depending on the price of the asset, but more than I expected. That's something I didn't know about options. And especially like now that like there's like fractional shares at most brokerages where you can buy just pieces of shares, like this is something that I kind of like have bumped up against as like a limiting factor when trading options. But yeah.
For sure. And I also didn't want to get too much into the nuances of like picking individual stocks and like betting on them because that felt a little bit too Vegas for me. And so I chose to only use the SPY index and was only trading options on SPY. Now, the way that I kind of kept my cost low was I was doing a little bit of buying and selling, which the selling side of options trading can potentially be really scary, right? Because that is where you can hypothetically run into like an unlimited amount of loss. But I tried to research some strategies online that tried to mitigate that. Truthfully, I don't think I researched correctly. And so we can dive into the specific positions in a little bit, but that was kind of my overall strategy. Pick the market index fund and how can I minimize the total dollar amount spend per position. And I made 3 specific positions for this one. So that was me.
Okay, nice. Yeah, so just like really focusing on risk management and trying to like preserve the capital until you like can hit a big win, which is like, yeah, that's like I feel like that's like how you should be trading, honestly. Like, that's kind of the opposite of what I've done. um, I've kind of gone all in on a single bet, and it's paying off so far. So, yeah, that's not typically how I would like approach markets. I honestly typically want to be doing or I want to be. I would say I would typically would want to be doing kind of like what you're doing, but like having a lot of different bets where you're using all the capital right in the portfolio, but they're on different bets, so they're uncorrelated, which is what I was planning on doing. Kind of expressing my view about what's going on overall in the economy, but in different asset classes. So you know, but given getting into this and we only have $1,000 and seeing how much it actually costs to place a position, I kind of decided to go a different route. But anyway, yeah, I think that'll make it for a good like contrast. Like we're kind of trying different things here. So, but yeah, my overarching strategy is kind of trying to focus on trading the macroeconomic dynamics that are currently going on. I think it's a particularly opportune time to like be looking at the macro picture and attempting to make bets about on different assets based on what's going on, because we're in a really unique environment, especially relative to like the past 40 years essentially, because of things like inflation and the interest rate dynamics. Um, so I'm gonna try to pull up a chart here. Is that okay? Is
Yeah,
that
of
too
course.
fancy for us?
No, pull it up, man. While you're pulling it up, maybe I'll give a little more detail, or ask a question, a follow up question for you. Um, did you were you actively changing your positions like daily or every couple days, or did you just make a overarching bet like a year down the line, and you just kept those positions open?
Um, Thus far, I've just kept the positions open. I took essentially a single bet on the stock market going down. I made that bet across 5 different products that are all just stock products. So there's like a little bit of diversification there,
Yeah.
but mostly, it's all just the same exposure. Like it's going to be what is the overall stock market doing? That's going to determine kind of the outcome of
Yeah.
the bulk of these trades.
See,
Um,
that's interesting because again, in the exact opposite way, I was making very short term bets.
right,
So
right.
I mentioned I made 3 trades. One of them I just completely messed up on because I was taking like volatility type trades. I was betting on volatility essentially, but essentially a neutral price. And so I mistakenly made one bet for 3 months in the future without really understanding what I was saying there.
Uh huh.
And that one just immediately kind of went to shit because it was like obviously the price isn't going to stay neutral for 3 months down the road. Well, it could, but it hasn't.
So
Um,
is that the bet that you're making? I'm honestly not familiar. I'm aware of volatility spreads, but I'm not
yeah,
quite sure like what the like how it's supposed to pay out. So it's a
right.
bet on the price staying
Neutral was the
relatively
one that I was making the
okay.
bet on. And so and I'll explain why when maybe a little bit later. But what I should have done was because I was making like a neutral bet, I should have done a very short time frame because the
Yeah.
price can't move very much in like a week or 2 weeks or whatever. But I made a mistake. I made it for 3 months down the future, and that one almost immediately just completely lost all value. Um,
Nice.
yeah,
So could you make the other bet though? Could you make it the price is going to be much different, either higher or lower down the line? And could you also place it
yeah,
that way? Do
yeah,
you
yeah,
know?
yeah, for sure, for sure. And the reason I made that volatility bet, well, I want to let you pull up your chart first before we get into the details of our positions.
Okay, so basically the chart I have up, it's the U.S. core inflation rate from like 1980 to now, and also beneath it is the uh, the Fed funds rate from the same time frame, like the 80s till now.
Okay.
And basically, what it's showing is the inflation rate for the past like 40 years has been pretty like just oscillating around 2%, which is the Fed's target, right?
Right.
And since COVID, like kind of following COVID, inflation has kind of skyrocketed. It's
Yeah.
been much higher than it has been at any point in the recent future or the recent past. And then simultaneously, you have the Fed funds rate, which has been, um, pretty much in a downtrend for the past 40 years. You have that going up to really, really high levels relative to kind of the recent past. So my point in all this is that I feel like because of these dynamics and how these dynamics affect asset prices, um, and kind of the mechanics of the way that the macroeconomy works, like most people don't have those like dynamics fresh in their mind because they haven't been an issue in like
Mm-hmm.
at any, especially like in our time frame, since we've been
Right.
investing.
Yeah.
And even if you've been, a financial advisor or asset manager for the past like 20 years, you still haven't really had to deal with these things that that recently. So yeah.
I definitely understand, the interest rate and inflation thing. Why did that lead you to just make a purely like negative bet on the stock market?
Yeah, so and you probably know this because you've taken some academic finance courses, and also
Yeah.
you were talking about in your last video, the investment banking one. You know, when you're valuing a stock or you're valuing a company, right? It's you know it's always relative to what the risk-free rate is, right?
Mm-hmm.
So you were talking about discounted cash flow models. I don't I learned about those, all the various
Yeah.
models you can use to value companies. I don't ever use them, but like, the theory behind them is sound, but you're always plugging in a risk-free rate, right? And that's going to
Right.
affect what the valuation is, right?
Correct.
So, the risk-free rate, it's typically referred to as like a treasury bill. What is the yield on a treasury bill? Because
Right.
if you buy a treasury bill, you're just basically loaning money to the U.S. government for a
Right.
very,
And,
very
and
short
it's
term.
guaranteed return, hypothetically.
Right.
Well,
Yeah,
and it's been
because
backed historically, so.
yeah, and the reason behind that is because the U.S. government can just print money. So like,
Mm-hmm.
they're not going to default on it because they can just they're creating the money, and it's like okay, that creates inflation or whatever, but like the nominal return on that is guaranteed essentially.
Got it.
And so that rate that's built into the prices of all assets, right?
Correct.
And the reason is because you know if you have a choice, should I invest in this thing that has no risk and I can get this return on it,
Right.
and then you compare that to a risky asset where the price moves a lot. Well, I'm gonna need a return higher than that of the risk-free asset for this
Correct.
to make sense to invest into, right?
Correct.
So if all of a sudden the risk-free rate, which is here on this chart, goes
So
up
that treasury yield.
tremendously,
Mm-hmm.
and all other things are equal, right? The prices of stocks should have to come down because um, the return out into the future needs to be higher, and to do that, to make that, like, companies
Ah,
just don't all of a
I
sudden start
see.
making more money.
I
So the price has
understand.
to adjust, right?
That's
Um,
interesting. Okay.
yeah, so that's like the theory behind why that has, and it's not just stocks. It really like the rising of the risk free rate. It impacts all asset prices, right?
Yeah.
So it's just creating this weight that has to, you know, bring prices down relative to what they used to be, because if they were priced relative to like an essentially zero risk free rate, and now the risk free rate is 5 or whatever, there needs to be a repricing for those investments to make sense at that, so
That makes sense.
that's kind of that's the theory. And so I'm going to pull up another chart, and so this is just the S&P 500. But I wish you could see this, but I guess it's making me have to explain it better. But anyway, so essentially what this chart is it's the S&P 500 is the the green and red candlestick
Okay.
chart, and then the light blue line here, this is like the long-term treasury bonds. Um,
Okay. The yield.
so it's the price. So it's like an
Okay.
ETF. It's the price of the
Gotcha.
bonds themselves. So when the price is going down, the yields are going way up, right? So
Right.
this downward price movement is reflecting the fact that yields have gone up a lot. The risk free rate, well, and the long term bonds kind of have somewhat different dynamics because the Fed is setting the short term rate, which has an effect on the long term rate, but they're not
Right.
directly setting the long term rates, right?
Got it.
Um, but yeah, so for the past 40 years, where inflation has been benign, it's been at the 2%, the Fed's 2% target. Basically, that creates a dynamic where whenever there is weakness in the economy, the Fed can step in and lower rates to stimulate the economy, right?
Mm-hmm.
And so the lowering of the risk-free rate or the short-term interest rate, that's immediately that shoots bond prices up, right? Long-term
Mm-hmm.
bond prices. So and then not super immediately, but over time that stimulates the economy and that is beneficial for stocks, right?
Right.
So that's why for the past like 40 years, like the best portfolio to hold is like a portfolio of US stocks and a portfolio of long-term US treasury bonds because of that dynamic playing out very very consistently. Every time the US economy gets weak, and stocks kind of sell off in anticipation of that because
Right.
stocks or prices are kind of looking into the future a little bit. And then so stocks sell off, Fed steps in, lowers rates, that shoots bond prices up, so that balances out the portfolio, and then that stimulates the
To go
economy, and
even higher.
therefore stocks go higher. So that's pretty much like literally for the past 40 years, that's like been the best bet to make is stocks and long-term bonds, and
Yeah.
the reason for that is because of those mechanics, right? The Fed just is stepping in to support your stocks, and then the like I showed on the last chart, like the interest rate trend has been just down for the past 40 years.
Mm-hmm.
Um, and so basically, here at COVID, like that's changed, and why has that changed? And it's because the stimulus during COVID created inflation,
Right.
and it's like we can debate why.
Lots of wealth,
Yeah, right. And that's like a
disposable
discussion for another
income.
time. Yeah,
Yeah,
that
yeah,
and
yeah.
then
Not like a political discussion. Just financially, what
right.
happened was lots of surplus income available.
Right. So what? So you can see the dynamics here. I've kind of done a play-by-play. So here's COVID, stocks crash. Because the economy essentially is halted,
Mm-hmm.
and the Fed steps in and they raise the short-term rate, the Fed funds rate to essentially zero, and that shoots bonds up. And then here in January of 21, that's right when you see that's when you start to see inflation like becoming a problem, right?
Okay.
Kind of inflation shooting up, and so you can see bonds start selling off because of that, because um, you know bonds have a fixed yield, so like the yields
Right. The
need
return
to
is now
make
becoming worse.
yes, they need to make sense in terms of whatever inflation is. That doesn't really affect stocks here because the economy is still strong. Inflation doesn't necessarily mean a weak stock market. And then here in 2022, this is when you get the Fed start hiking rates, and so you can
Yep.
definitely you see this is really the inflection point because this is where stocks sell off and bonds sell off. So like that uncorrelated dynamic between the two assets has now disappeared
Right.
because the inflation has the inflation is being recognized now as being a legitimate problem, and here it was just transitory, and that's probably why stocks didn't really sell off, because it was like everyone believed it to be transitory, essentially meaning like it's just a blip, it's just
Yeah.
a little spout of random inflation, and it's gonna go away. But so yeah, and then the when the Fed the Fed acknowledges here in January of 2022 that the inflation is not transitory and we need to start hiking rates to slow down the economy. And so for stocks here, you start seeing them sell off. And at this point in time, it makes sense. This is making sense to me. Like, oh, this is how it should be playing out. The short-term rates have risen a lot, so that that should bring the prices of all assets down, and so you see that in both stocks and bonds here. And then also, there's the part where the rising of rates is going to have some tightening effect on the economy, right? Because that's also like the cost of what it is to borrow,
Right.
So,
less disposable income now.
So yeah, like you have these two major like pressures on stocks. So it makes sense that they start selling off here. And then what you start seeing here in October of 2022 is basically a massive rally back up to the highs for stocks.
Even though bonds are staying flat.
Right. Yes. And so basically what's happening here is the stock market is starting to price in that the Fed is going to start cutting rates soon, because inflation peaks here. So if I go back here, inflation kind of peaks right here in October, right? And it starts coming down, right? Mm-hmm. So the consensus in the market is, hey, inflation's under control. These rates are way too high relative to the recent past. So the Fed's clearly going to start cutting rates back to trying to get back to zero as soon as possible. But the Fed's mandate is, it's not to keep your portfolio,
happy.
Keep your portfolio happy, right?
Yeah.
It's to keep inflation at 2%, and it's to keep employment at whatever their employment target is. And
right,
so
because we didn't see them lower rates. They actually continued to raise rates, right?
Yeah, exactly. So that's kind of the opportunity here that this is kind of started when we started making trades. That's kind of the opportunity that I saw as like, hey, like this doesn't make sense. Like the Fed is not going to just start. The Fed will start cutting rates, but they're not going to start cutting rates until the economy is actually weak.
Right.
And we haven't seen economic weakness. We're starting to see a little bit now, but like this was people having much too optimistic expectations about the trajectory of the interest rate policy in my view, and that's the bet I've taken. But it just doesn't make sense that the Fed is going to start cutting rates when like inflation's still at 4%.
Right.
That's
right.
not 2%, and especially it doesn't make sense when the economy is still strong and the employment market is like fine.
So your overarching viewpoint here is not going to start cutting rates, and so because of that, you will continue to see this stock market correction that prices in the continued decline of bonds, and so therefore, call it for the foreseeable future, you think there will be a sell-off of stocks, and that's why you went all in on this, short, option short.
Yeah, essentially, and I discussed wanting, ideally you would want to not go all in on one asset or one trade or whatever, and so I would have liked to have. I did actually trade this move in the bond market in my personal account, but by the time that we started, this had pretty much already happened, and it doesn't. Bonds down here don't seem as good of a short to me as they did up here. So like a lot of that has in the bond market has already sold off like a seemingly adequate amount, and then other trades I was looking at is like going long commodities, which is like would be kind of an inflation trade.
Right.
And so that has played out a little bit too. Like if you look at oil has had a big rally kind of over the same period. So really at the time of when we started trading, like the big thing left was like, hey, stocks still seem way overpriced relative to like what's likely to transpire, right? And what likely is to transpire is that the Fed's not going to like start cutting rates until like the economy is visibly weak. Like we have the weakness in the data, and so like if the weakness is in the data, then stocks also have to be a lot lower than they are now because
Right.
stocks haven't even started price. Stocks haven't yet priced in a recession, and they haven't priced in really the rate, the increase in yields from this bond move, right? Because now people are looking at long-term bonds and seeing these like really really attractive rates, and like now stocks are being compared relative to that, right? So stocks essentially need to sell off to become a more attractive investment. They're not very
Correct.
attractive right now.
Okay.
But yeah, that's kind of the core thesis behind the trade that I've made.
Well, let's maybe switch gears into specifics a little bit here. So for me, I mentioned that I was only trading on SPY, and sounds like that's not necessarily the case for you. You were trading a couple different things, but yeah, let's talk about it. So I did two specific types of trades. One was called a butterfly, and the other one was called the iron condor. I chose to go for these things that got fancy names because I don't know, I thought it was cool. But so the butterfly to start with, actually this one specifically may have been called like a Christmas tree butterfly or something along those lines. Listen, I looked it up one time and I was like, this sounds like a really good idea, and I was like, let me try it. Didn't work. Fun fact. But essentially the idea was you bought, let's see, it was in like a ratio of, you bought three different contracts at three different prices, right? But at a ratio of like 3 to 2 to 1. Okay.
Okay.
And so what I did was I bought a call option at 424. I bought two call options at 424, and then two call options at 427. Now, when I bought those, the price of SPY was around 425, meaning I was buying the 424 call, already in the money as a little bit of a hedge. And then you're buying the 427 call to, get that potential upside as the market goes up. Now, going back to my initial point of how can I do that for the least money possible? Well, okay, if you sell that same options chain, you can get you can get credit as money, right, that you can spend today, and then you can buy yourself protection essentially. And so I sold. So let me run it back. I bought 2 at 424. I bought 4 at 427. I sold 6, so fully protecting that entire contract spread at 426. So still above the current market price, but below what I was expecting it to go to.
Okay.
And so essentially what break even would need to be, and this isn't the exact math, but essentially the break even would need to be in between this 426, 427. So then, because I have to, if someone wants to close on the 426 that I sold, I need to be able to buy back shares to sell to them. You know what I mean?
For sure. Yeah.
And so the total cost for buying and selling those 12 options contracts was only $16.
Oh, wow.
Total. But of course, and then I that was the one that I did properly, and I did it for just 1 week out. Actually, it wasn't even. Yeah. It was for 1 week out. Unfortunately, literally the day that I made that trade, the very next day, the market tanked. I don't know why. It quite literally went down like 3%. SPY went down like 3% in a single day. And I was just like, what the fuck just happened? So I panicked because on the bottom side of it, I was losing a lot of money. Like, because I don't know if I explained the mechanics properly, but all I know is that I was losing a lot of money. I was like very quickly seeing it going up into like the -100, -200 range.
Okay.
On a trade that I literally spent $16 on, and so I was like freaking out, and I was like, I have to close this option to minimize my losses, and so I closed that option at a loss of $88. So I spent 16, also lost 88.
Do you know? Do you have an idea? I'm curious. Like, do you know what like the upside payoff like could have been?
No, because I was betting on the call, so it could have hypothetically been. Oh wait, actually,
Also, are you setting these up like through the Robinhood like
yeah,
pre? That is honestly really cool.
you can do multiple contracts on the same chain in a single trade.
Yeah, and honestly, man, can I insert my Robinhood quip here?
Yeah, if you want to.
I'm just like I I'm just trading like the vanilla buy like call and put options, but I just think it's like honestly truly incredible that we can like quickly open a brokerage account on our phone and like trade options like complex options like this like for free. Like it it seems like we've come a long way. And obviously like it gets a lot of it's gotten a lot of pushback in the media and stuff, but like um I don't know. I appreciate it because like I like to I like I'm a I like to go I can go into here and like mess around with things and like learn, Like you have to be trying this stuff out to learn it. You can't just go like study it and like you have to learn, but like if you're paying high commissions on whatever product you're trading, it's like already the odds are stacked against you because this is super complicated, but like it is guaranteed to be stacked against you if like the commissions are really high. So I don't know.
Um, so I am unable to find what the potential payout would have been, but I'm fairly certain it would have been like the maximum payout would have been like $124 or something on
Okay.
$16 to spend.
Right.
So like a 5x return, it would have been great. Now the other one that I made was the one that I mentioned earlier, the one that I accidentally made it like way out into the future. That one I also placed the order incorrectly, so instead of spending money to buy the upside, I accidentally oversold and then like got excess credit. And then I just like that one is just like completely out of the money and it's not going to go anywhere and it's dead.
So was that like did it ask you if you wanted a credit or a debit at that
Yeah,
point?
it did,
Okay.
and I think it gave you the choice, and I think I just fat fingered it, mistyped.
Yeah.
Um,
I at one point it asked me that too, and I was like, I feel like I shouldn't have to be specifying this. Like I don't want to choose
right,
like the wrong, but I don't know.
right. I agree. But that one, I got a credit of $20 to start with. Actually, technically, that position is still open for me because I've been trying to close it for 2 weeks now, and I just can't close it because like the potential I could make off of it is like $3 or something like that, and I physically cannot get anyone to fill the order. So
Oh,
I've tried.
like
Yeah, like
no one
like
will buy it.
right, like the bid ask spread is so high
Yeah.
that I just can't, like physically cannot get it to close. No one will fill the order, and so
Well,
it's been just
maybe
stuck for.
I can go in there and put an order in for you.
Thanks.
Take it off
Give
your
me
hands.
$3. And then the last one I did was the Iron Condor. Similar concept, but a little bit different. So this one, I bought let me see what this one I did on QQQ.
Okay, nice.
I don't know why, but I did. Um, and at the time, QQQ was sitting at between 363 and 356. So call it like 360. And what you do for an iron condor. And people, go do your own research. Don't listen to my reasonings here.
We're not trying to teach people here. We're trying to entertain.
Yeah. And so you buy a call above the current price. You also buy a call below the current price in the money. And then just below and just above where you just bought at, you sell to.
Okay.
Okay. And essentially what that does is that's going to create a collar of you're expecting the, like, you know, if the price goes above 363, like say it goes like 400, right? Then because you've got the right to buy at 363, like you're going to make a lot of money on that trade. However, if, you know, the other one that you bought that was at 362, just $1 below, that one's also going to go up. So you're only going to make the difference in the price of those two contracts on either side. Does that make sense?
Yeah.
And so because you have to close the sell. Right. And so the potential that you're going to make is not nearly as high as if you only bought like the 363 and were expecting it to like skyrocket. But again, in a similar fashion, you're like minimizing your spend. And so I spent on that one $52, or actually I received $52 for the trade. And then I was going to try to close it out at a maximum potential of, again, like 100 or something like that. Similarly, again, that was like a long call bet. And like I mentioned, the market like lost 3% in the next day or whatever the fuck. And so, that one also went to shit. And I lost $90 on that one.
Dang.
But luckily on that one, like I started off making $52. And so I didn't actually lose 90 total, if that makes sense. Like I got income of 52, then lost value of 90. And so it was like only a $48 loss or something overall.
Nice.
Well, yeah.
So is that all? Is that all the trades you made?
Yes, I only made those 3, and they are all closed now.
Well, that's definitely interesting. I'm probably gonna look into some of those because the concept of like being able to do more with less money is like, you know,
right.
That's kind of the whole point of this thing, you know?
Yeah.
So yeah, I don't know. That's interesting. I haven't looked into like the different like strategies that you can implement. I've just been, you know, if I want to go long, I'm buying a call. If I want to go short, I'm buying a put. But
well, the interesting thing is though, like you at least have made the bet in the right direction. I made the bet in the opposite direction. That's a good point.
Fault, yeah.
You know,
at the end of the day, all these like different product, you know, the different types of contract stuff. It's like still there's a directional bet embedded in it.
Right, exactly.
It's either price goes up or price goes down, or in terms of volatility, it's volatility's neutral or it's
exactly
higher.
Exactly.
But
so you went for specific companies.
Well, so not for the reason of having to do with anything to do with the companies themselves. Actually, I'm like quite fond of the companies that I shorted. So like, I don't hate these companies. I think they're good companies. I just like,
in picking 5 different companies, you were essentially using that as like a handpicked random sample of the U.S. stock market.
Yeah, well, so actually, the products that I chose, 2 of them are like representative of individual stocks. The other 3 are like sectors, I guess.
Oh, okay, interesting.
But no, so I probably the most interesting is I'm all my bets were on like leveraged ETFs essentially.
Okay, and like then, similar to like QQQ.
Yeah, but like I don't know if I bought a call on SQQQ, which is like the 3x inverse of.
Okay. Wait, you QQQ. Bought a call on the 3x inverse. Okay, yes. Which is still a negative bet on the market.
Right. I'm betting that the short QQQ ETF will go up because a short ETF will go up when the underlying goes down.
Yes,
right?
Got it.
So we're doing some complicated stuff here. Like, yeah. So, yeah, I picked all leverage ETFs, and my thought process behind this was like, you know, with options, it's like you're making a directional bet, right? and then if it doesn't go in your direction, it's worthless, right?
Mm-hmm.
So it doesn't really matter how much it goes badly and badly not in your direction, right?
Right.
But if it goes in your direction, you want it to go in your direction as much as possible because you're going to
Right.
make more money. So with leveraged ETFs, like you're essentially just getting a
Ah, I
higher volatility.
see. Got it.
And so
Right.
I wouldn't want to like own these. I wouldn't want to own these products because, well, multiple reasons. Just because like how volatile they are, and then also like they kind of. Do you know much about these? Like
Yeah. Yeah.
they
Yeah.
they track the whatever the underlying index is on a daily basis, like the return on a daily basis. So
Mm-hmm.
they have this problem of I think it's referred to as like
Delay.
volatility decay, but like
Okay.
basically it's like because it's like the leverage like resets like every day. It's not just like your fully outright leverage. So basically they just like they don't over a long periods of time they don't track it exactly and it's always to the downside. So like
Interesting. Okay.
um and it's just because of the nature of like if like a stock goes like or like if the index goes up 10% and then the next day it like comes down like 5%. So like we were at this level and then we came down to this level. It needs to go up like more than that percentage amount, that downward percentage amount to get back to this level. So when you take
Mm-hmm.
that dynamic and you leverage it up, it basically like they get these ETFs have like a drag on them to the downside. They
Right.
like
Okay.
don't
Okay. Yeah.
like
That makes sense.
so anyway, that being said, you know, I don't so that was my reasoning though. Like they're more volatile, so like it doesn't really matter if it goes against me a lot, but if I am right and it goes in my favor, like it'll go a lot more than if I just bought like the if I just shorted the QQQ or whatever. Um, but what I don't know, and I would assume that like that dynamic, like is probably priced into the premium of the option, right?
I
Like
would assume so.
they might just be more expensive because they're more volatile. Because like
Yeah.
implied volatility is like one of the like like pricing factors of an option. So I don't know. I would imagine that that probably is priced into them to a degree, but I don't know that for sure. But anyway, I went ahead and went with it anyway. So, um, yeah. So I bought a call option, a $28 call option on SQQQ, uh,
Okay.
and just a couple of these expire in February of next year, and three of them expire in March. So
Okay. So about 6 months.
yeah, I'm basically making this bet on a 6 month time frame. Um, so yeah, uh, SQQQ I have a $28 call. I wish I could see pretty easily like what this is trading at. SQQQ currently is at $22. Um,
And that is a good. That's a bad thing for you. That means tech has gone up since you made that trade.
um, actually, no. So I all these are way out of the money. Um, so like
Oh, I see.
they've all gone in my favor price wise, but like they're
Got
still
it.
way out of the money.
Got it.
Um,
Understood. Understood. But
yeah.
meaning
So
the price of your contracts have increased.
yes, yes.
Understood. Okay.
So like, and that's gonna like now I'm in this place, and I knew I was gonna be in this place with this strategy because you know it's like the the value of my portfolio has gone up a lot, but like it like I'm still out of the money on all the positions, so it's like you know like if the prices stay the same that they are now, it's like my portfolio is still worthless at the end of when these all
Yeah.
expire, right?
Right. I
So it's
mean,
like I still have to decide like when I want to exit.
yeah.
Um,
Yeah.
and so that's something I'm gonna be like grappling with because, um,
Don't get greedy. Don't get
yeah, I
greedy.
don't know. Well, it's like I don't know. It's like, do I want to like try to YOLO it and like I picked strike prices that I was like, I mean, things would get pretty bad if like we get there, but you know, I
Yeah.
feel like there's a plausible path that we could get there in the next 6 months. But
Right.
you know, I don't know. At some point, I might be like, all right, things have kind of played out to the extent that I thought they were going to play out, and I'm going to take my profits, and
Yeah.
or I could like start taking profits and making other bets,
Yeah.
if things start changing or whatever. But as of right now, like I still just my initial thesis is still just like it's playing out in
It's
my
held
head,
true.
like
Yeah.
yeah, and so like I'm just and nothing has like changed it, so like I'm just gonna keep holding, I guess.
Yeah.
Um, but yeah, and so SQQQ I bought the call on. DRN I bought a put on. DRN is just like the 3x real estate ETF.
Okay. So
Um,
betting that real estate's going to go down.
yeah, and real estate there, really, I'm not too invested in any of one of these like sectors or companies or anything. It's like I was literally just trying to like find like the most volatile stock market products
Yeah.
because they're going to move the most.
Yeah.
And then also like trying to find the ones with the most liquidity because like you said, you have this product now that no one will buy. So
Right.
like I
Right.
wanted to try to like not get into that,
Yeah.
or try to avoid that. And it's like I guess you basically just have to go into Robinhood and like see if there's anything trading on these options. That's
Yeah.
kind of what I did. But anyway, like there was other products that I kind of was more interested in, but like they had no liquidity, so I was like, all right,
Yeah. Exactly.
I can't trade this. But
Right.
so and then SOX S, so that's the inverse,
Of stock sell.
um, yeah, which is the semiconductor
Semiconductor.
ETF.
Yeah. Yeah.
Um, and then NVDS, which is
Nvidia.
it's like a leveraged Nvidia inverse product.
Oh, really?
Uh,
Oh,
yeah, like
weird.
it's kind of crazy. There's like all these like products like that coming out now.
A
Like
leveraged on a single stock. That's kind of crazy.
yeah, there's like a lot of them too,
Hmm.
and like they're coming out like it seems like every week. There's also like so this is 1.25x short
Okay.
Nvidia. So it's leveraged like 25% to the short side,
Yeah.
and it's like inverse.
Yeah.
So it's going to be more volatile than Nvidia itself, which is already super volatile. So
Right.
um, and then TSLL I bought a put on, which is a 1.5x leveraged long Tesla ETF.
Weird. Okay.
Yeah, I know it is weird. I'm honestly surprised that who
These
let these
types of
come
stocks.
into existence.
Yeah. Yeah.
Like
Huh.
this doesn't seem like things that are necessarily
You're.
safe for.
I mean,
But
you're very highly indexed in tech, more specifically in semiconductors.
well, yeah, and I didn't really like I said, it's mostly just a bet on stocks. So like I'm just trying to
Yeah.
like get the most volatility. I also think that like tech and real estate, I don't. I mean, I think they're kind of known as being more like interest rate sensitive, and like the
Yeah.
dynamic that I am talking about is interest rate driven. So like, I think that these sectors are probably like more, and also like they've just kind of outperformed like other sectors over the recent decade or so. So like,
Right.
I just think they're more positioned to like get hurt from these dynamics. So that's all it is. Like, I love Tesla. Like, I love Nvidia. I think they're cool companies.
Yeah.
Tesla was actually like the first individual stock that I like actually made a lot of money on. So
Dude,
you know,
me too.
yeah. So it's like, I I love these companies and like I would own them in the long run, but like I just
Not in the
I have to
6 month
be
run.
I have to be practical and realistic about
Yeah.
what I think where prices are and stuff.
Hey,
So
and I mean, I think that's probably the hardest part about stock trading.
yeah.
But okay, should we do the grand reveal of our portfolio values?
Yeah, let's do it.
All right, since I've been taking my turn going first, I will go first again. Um, So my portfolio started at $1,000 and currently, as of today, is sitting at $885.55.
All right, not bad.
So
You
a loss of $115.
Yeah, but I mean, it's not zero yet. You can
It's
still
true.
keep
It's
playing.
not zero.
And
We
I
got
mean, you did a
8 episodes left apparently. Lose $100 an episode.
you and I mean like that's you manage your risk though, and that seemed like a lot of like the
That's true.
strategies you were implementing were like, hey, like
Right.
I'm getting upside, but I'm limiting my downside, and that's it.
Correct. That was most
Yeah,
of my strategy, was limiting the downside because I knew I was going to fuck up.
right. So I started with $1,030 because
Wow,
I put it.
cheater, cheater,
We can subtract
pumpkin
that out if we need
eater.
to.
Yeah. Well, no, we can't. We can't. You ruined the entire experiment. That extra $30, that's why you got so far ahead.
I guess so. Yeah, it really leveraged me up. Um,
Yeah, speaking of leverage, you got a 3% leveraged portfolio.
but yeah, my portfolio is at 1574.
Whoa.
So I'm up around 57%.
Dude, you should definitely take your money, level set, and reset the board. You know?
Yeah, I don't know though. You know, should I?
Don't get greedy. Put it in the comments. Tell Maddox to take his money and put it in the bank. Well, at the very least, right? You can take your money, reset, and then now you can. I mean, you could even make the same bets just at a larger volume.
Yeah, that's interesting. I wonder how that would like affect the like expected return.
Well, you would have to adjust your strike prices on all your
Right.
contracts. But
Yeah.
just some thoughts. I don't know if I'd be taking advice from the guy that lost 1,500 or $115, but you know,
I don't know. I don't know what I'm gonna do. I mean, at the end of the day, it's like it's just $500.
yeah. I mean, true.
It's,
Hey, true, but also at the same time, it's 50% of your returns on your portfolio.
yeah, of this small $1,000 portfolio that we.
I mean, yeah, yeah,
I mean, yeah, it's interesting because it's like because of that, I'm like not like I'm probably not like operating as I like normally would,
yeah.
because it's
Well,
like a small amount and like I already decided like, hey, I'm gonna like YOLO this kind of and see how it plays out. But now that it's playing out, I'm like maybe like I don't know. It's like the trade was I made the trade at that point in time. I was like I think they can go down. I think these products could go down to these price levels, and just for transparency, like I kind of picked like around like a 50% declines in
yeah,
in these products, and like they're highly leveraged though, so like that's honestly not that
yeah.
big of a
That's not
move,
that crazy.
big of a move,
Right,
But
right.
that's just to get to my strike price. And then ideally you would need to get to like beyond that for it to really like blow up
Yeah, yeah.
before your expiration date. But yeah, I don't know. We'll see.
Well, I guess those were your main takeaways, right? Your lessons learned were the. I guess what was it specifically? The one was, of course, like because you chose things so far out, you don't know like if you should sell early or not,
Yeah.
right? I know we already touched on that. Any other specific lessons learned?
Just the like the amount of money that it takes was like more than I expected. So like it's kind of hard to build like a really diverse portfolio, and it's like
Yeah,
in options, it's like ideally if you're investing in asset classes or ETFs or whatever, like you would want to build just like diversified across that dimension. But and then options is like I want to also be diversified. Like if I had enough money, it's like I could have made these long dated bets, and I also could have
yeah,
made like short term bets. And so those
right.
short term bets could be like expiring right now. I could be taking profits and then like moving that into something else. And so like I
Well,
guess
maybe
that's kind of
you
like
can take some of that $500 and do some of the strategies that I did that only cost like 16 to 20 bucks.
yeah, right.
And
And
see,
yeah, I'm interested in trying that because I think that's interesting.
yeah,
I think it's
yeah.
like you could do some cool stuff with that.
Well, final thoughts for me. Lessons learned. Probably do the exact opposite of everything I did. You know,
Yeah.
don't mistakenly make a bet thinking you understand what it is. But that being said, I do think I don't know if I would do the butterfly again or the Christmas tree, whatever I called it. Because you're now mixing in like three different strike prices, and I think that concept is maybe a little too complicated even for me. And when I thought that I understood, I don't know that I necessarily fully understood. You know what I mean?
Yeah.
The Iron Condor, I'd be interested in trying again, or maybe just like a buy one call, sell one call type strategy. I'm going to continue to try to hedge the amount of money that I'm putting in and minimize my risk for sure. But I don't know. I might going forward take your approach here.
Well, I was curious, like, were you like particularly bullish on the stock market, or were you just like kind of just, stock market typically goes up, like,
So it's a good question. I wasn't particularly bullish in the long term. I was bullish on the short term, like 1 to 2 weeks, because the trend the prior 2 weeks had been consistent decline. So my
right.
bet was with no type of analysis at all. I was just like, oh, it's gone down for two
Yeah.
weeks. It'll probably bounce back up.
I mean, that's like fair. It's like mean
Yeah.
reversion is, especially on the short term, like is definitely a thing. So,
Right. And so that was kind of my thought process. And that's why I assumed that would happen. Now, I guess the other interesting thing to see would be like there have been a lot of like global events happen since we started as well.
yeah.
And so we don't have to get into any like details of anything, but it'd be interesting to see if in the near to mid-term, call it 3 to 6 months around the time that yours close, if any of these like global events are causing the U.S. stock market to decline as well.
Yeah.
And I don't know. I'd have to look into kind of historically how that has worked. And
I think
I mean, I assume
just
historically, like the idea of war, generally speaking, like makes the stock market go down
yeah, it's like not good for stocks, even if you're not in that, even if it's not the stock market of that particular country.
on like a global scale. It's like all
Right.
connected.
Right.
So I don't know. So based off of that, maybe I should take the stance that you're taking and be a little bearish.
To see that as like another, like I talked about the rates and the
Yeah.
inflation, and then the rates kind of like, probably gonna start showing, like we're gonna start seeing some weakness in the economy because the effect of those higher rates are starting to like show up.
Yeah.
But I would also say like the global conflict, like that's like, yeah, there's been like a lot of that, and so like that's just kind of
Right.
like another like additive factor, I would say.
Right.
Not that I know
Right.
anything about geopolitics. I'm the guy that wore the American flag tie to the or
Prom.
the to the no to the Model UN meeting. The
Yeah. I remember.
so
No, I agree. And we're not on here to talk about geopolitics, but it would be interesting maybe to at some point discuss the effects of geopolitics on finance and financial markets.
yeah, for sure.
That's one thing. That's one thing that I think we probably could speak on. All that to say, thank you guys for watching this episode of Jerome's trying not to go broke. A little bit longer of an episode than we probably thought, but hopefully you guys learned a lot, or I definitely got some tips, and we'll be approaching this a little bit differently for the next time around. Use hashtag Team Jerome or Team Maddox. Don't count me out yet. I can turn this around. And make sure to like, subscribe, do all the good things, comment, pass it to your friends, play along if you got $1,000. And peace.